So I'm very pleased to welcome Trilliam, who is the Chief CEO of the WealthBlock. And I'm very pleased and honored to have joining me at the table Brady Fletcher, who is Managing Director and Head of a TSX Venture Exchange. Welcome, guys, to this table.
Good to be here.
Good to be here.
So my first question will be addressed to you, Trilliam. What is the pain point in addressing in your company?
I think there are two primary pain points when it comes to private capital market and private fundraising. The number one is pretty commonly known as the fragmentation and cost and inefficiency caused mostly by regulation. So you need to go through a lot of hoops for anyone who has any experience raising private capital before. So know your customer, anti-money laundering, accreditation check, and also there's a lot of legal sign-off by your compliance officer, etc. Then there's also another component that people can say about, but they usually don't have any problem solutions for, which is investors tend to be finicky. That ties into very interestingly to human nature. We have a fundamental fear of saying no, rejection and confrontation, also the fear of missing out. So combine those two, finicky.
What is your offering to clients now?
Since I mentioned those two primary pain points, so I designed a platform specifically for those two pain points. The first one is pretty commonplace by now, since 7 years ago when crowdfunding became a thing. So that means one-shop tool for everything you need for private placement. So starting from investor onboarding, suitability check, to viewing the investment docs and legal docs and sign off and payment.
So it's basically a platform.
That is correct.
A multi-sided platform.
Right. And through that checkout process, the onboarding process, we collect a bunch of behavior data, which I can use to measure the interest level and to perfect the timing of follow-up. And that's the kind of secret sauce here.
Yeah. And to whom it is addressed to? Who are your clients?
Starting off with the middlemen, the investment bankers, the broker-dealers, whoever make a living raising funds.
A couple of interesting questions here. You know, you've hit on crowdfunding, right? And it's obviously a big topic. You think about the U.S., fixed crowdfunding, Reg A+. How much of this is public versus private companies? Is it all private, all public? Where are you seeing most attraction today?
Good question. So we actually started off with the B2C platform, which I would call a public platform from the very beginning. But very quickly, I realized that there's some missing ingredients in that makes the middleman critical in this process. It's called trust. Most of the fragmentation in private capital raising space is actually still running on relationship and trust. So simply by saying that, okay, I can make everything go very smooth and go to the investors and mom and pops directly, saying that I can get you into a hotel deal, might not fly because there's a missing trust. Those guys don't know anything about a hotel deal, let alone do they trust the platform at all. Therefore, I leave that I leave that choice to our clients, the middlemen. So you decide. If you want to make your offer 506(b)(c), meaning private accreditation, accredited investors only, you can do so. If you want to make it open, Reg A+, then you can do so. It's your choice.
That's really interesting. You say the need for middlemen because, you know, especially when you're talking about venture stage deals that aren't yet high profile, you really do need somebody selling that transaction. So are you more of a white label solution then?
That is correct.
Yeah,
that is correct.
It's interesting for us because on the venture exchange, we had 1,700 financings last year, raising a total of $6.8 billion. And when you look at those numbers, over 1,400 of those were by way of private placement, and 1,100 of those were by way of non-brokered private placement. And so that's where you get into that really fragmented crowdfunding model where, you know, we have 1,700 listed companies that are looking to do these kinds of financing. So
how do you segment your customer right now?
We have 9 paying customers. 6 of them are actually US-based broker-dealers in private placement space. So they are all boutique private placement agents and the investment bankers. So ranging all the way from cannabis-related deals all the way to oil and gas or boutique hedge fund, PE fundraising. So their clients are all different and they each have their own specialty, but it's a relationship game. So when they go into anything, although they have a purpose, but very often they hear other deal flows and they also want to monetize them, but they don't have a way to do so. Therefore, this group of people, group of entities are very open to collaboration with others.
So you're advocating a reg-compliant investment fundraising process. How did you navigate through the waves of a regulation? Were there any enablers, barriers? How did you manage to do that, to go through?
A lot of enablers, actually. We were fortunate because, like I said, since 7 years ago that nothing was pretty much built for streamlining the private placement process, such as KYC, ML, accreditation check. That was the first generation of innovators were actually building that. And that enabled us to do it very quickly by leveraging all those integrations. So in under 4 months, we had our MVP out. And the secret is we only build a piece that we definitely need and nobody else has. But anything else, such as accreditation check, e-signature, etc., has already been commoditized. So we just leverage.
And so when you do this white label solution, who ends up owning the client account? Because you talk about doing the behavioral analytics. Is that you guys own the account at the end, or does the broker dealer own the account?
The broker dealers will own everything. Okay. They will simply say, we want a royalty-free license on the anonymous behavior data. We're going to mine it and generate a report for you to consume as well.
Interesting.
Investors often look at how defensible the technology is. Is that a concern?
You know, software is an interesting game, right? Because you can't really patent software. All you got to do is change one line of code, and all of a sudden it's there. And it's quite often that you see. It's the third guy to come out with an e-signature system that actually manages to scale. DocuSign, for instance, wasn't the sleekest, but they were the third guy out. They raised a ton of money from Kleiner Perkins, and now they've become the industry leader. And so I think that there's a lot of power to that. That if you can find the best of breed solutions and you're creating a real value proposition for somebody, it's huge value.
And for you, is it somehow defensible or? The technology?
Good. It's more of a strategic game.
Okay.
Once you add FIN to tag, then it actually changes the entire nature of this game altogether. Like I mentioned, the biggest defensible mode will come from relationship.
Okay.
Right. Like a DocuSign, if you get in early, establish that high switching cost. And especially when you're speaking with the enterprises, so switching cost is very high because of the potential disruption for the internal operation as well as external client management. So they stay, therefore you have that defensible mode.
Especially as you start dealing with larger financial institutions, once you get past the procurement process, you give them comfort on your back-end systems, the security that's there. We're all terrified of hacking today, right? So
cybersecurity is another concern as well. I mean, have you addressed some of the site security challenges within the company?
Yes. We have a standard protocol. Essentially, we are midware, right? So we house everything. We have our own code piece, but house everything in AWS. So we certainly leverage their point, all the connection point. And for each connection point that we expose to the outside world, then we perform routine checks, not by ourselves, but we'll hire outside contractor to perform them routinely. That allows us to scale a lot faster.
Do you see that these kind of companies are scalable or somehow attractive to the TSX?
Yeah, well, and that comes down to the number of transactions in the private placement space that we see on an annual basis, right? When you consider that the vast majority of the financings that happen on this market are tied to private placements, and that's just the public side. Then you think about all the private placements in Canada that go into private companies, there's a ton of activity there. All of which is based on subscription agreements today, which are cumbersome, paper-based. You got to fax it back and forth. You don't know whether somebody's actually read the risk disclosure, making sure that it all settles properly. There's a bunch of pieces in there that are friction points that it would be great if we could get past. The piece that you talk about defensibility, it's awesome once you get into an organization, and if you're plugged in and you're past the procurement process, then you're right, it's going to be very difficult to peel you out. The question is, how quickly can you do that? And how do you get to critical mass of being the de facto standard? I think that's a question of captivating investors and captivating the actual advisors that you're talking about. I think it's interesting, right? I mean, this whole space is moving so quickly, and so much of the whole financing process is being disrupted, right? And we have a TMX Group. Our role is to provide a platform that facilitates capital to meet companies, and then we're stronger when there's a strong ecosystem of fintech players, broker advisors, people who are distribution networks into the investors, and our number one priority is bringing more investors into the system. So it's an interesting proposition. Love to learn more.
Okay, Trilliam, Brady, thank you for having joined us. Thank you.
Thanks a lot.
Thanks a lot.
Cheers. Thanks.